Well, good morning, everyone. We're here to do a quick update on the natural gas and inventories and touch a little bit on the market. We're going to do something a little bit different here today and hopefully going forward. I am joined by Michael Korn today. Welcome, Michael.
Hey, thank you, Brynne. Hi, everybody.
So glad to have you here. So Michael he's been in the energy business for over 30 years, just a wealth of experience. Currently, he's actually an independent broker and has very interesting perspectives on some of the customer type flow that he sees. And he's able to come at the market from, just not thinking about, what trade or what the price signals are, but what is causing people to move to action. As he deals with a lot of really interesting people, both in the natural gas and the crude oil market. So I would say over the last 25 years, Mike and I's paths should have crossed 100 times.
Agreed.
Right. And yet it only did just within the last few years when we somehow both ended up living in New Jersey. And it's a small community outside of New York. And we ended up meeting. And I've just so enjoyed talking to Mike and getting his perspective on the markets, and it's always nice to have somebody to bounce something off of. And he has so kindly agreed to join me on this.
Oh, my pleasure. Hey, by the way, did you ever think you'd be living in New Jersey?
Not in a million years.
Same.
Minnesota girl. No, I didn't think so.
Chicago here. Yeah.
Right. We got to round out the Midwestern accents here. There's Tracy and Angie and myself, and now you. We've all got the Midwestern accents going. So.
A Midwestern accent skew.
Yeah, that's right. That's right. Maybe, I don't know, maybe that says something about the gene pool there. We're all smart. No, but anyway, I thought it'd be good to mix it up instead of just, doing standard presentations every time. It's always nice to hear, people talk back and forth about what's going on in the market. And Mike always kind of helps me look at things in a different way. So I thought first, let's just get the inventory number out of the way, because I know it just came out. The market was expecting 94 and the number came in at 90. So, if you want to just look at a singular week, as we talk about every time, the number was less than expected, although within the range. Doesn't change the overall picture. We're still at least 17% below last year and 5-year averages. The biggest criminal out there the biggest offender is still the salts storage caverns in the South Central. This chart I have up on the screen is basically just showing injections by region since April. And since April, salts storage has managed to put negative zero, less than zero into storage. So I think that speaks to why we ended up here in October, which can traditionally be a messy month when it comes for cash prices. Generally, we slide into October with inventory levels pretty high, or at least the last several years we have. And so operationally, you can just inject less and less. And the cash market tends to get a little messy, and that really weighs heavily on the futures. Yet this year, as we keep talking about, when is this storage level going to have any impact on markets? And we really saw that coming into cash pricing this month. I put a little chart up here about what some of the prices have been starting since October 1st. And it's really when Henry Hub cash prices started to move and print steadily above $3 every day. It was messy in a lot of the other regions, and that has to do with regional dynamics. And of course, both the Midwest and the East have been really on track with injecting And so it gets a little messier cash wise, and there's a lot of volatility, bouncing between $1 and $3 in some of the East Coast hubs. But really, it's the notable Henry Hub and Houston Ship Channel that started spiking first couple days of the month, and then that's when we started to see the futures rally. So that kind of gets the numbers out of the way, but I want to talk about that a little bit with Mike, right? Because don't you remember in years past, October was the month nobody wanted.
Right.
Everybody would sell October and buy the winter. They'd sell November, they'd sell October, and then that would bleed into November.
Right. And those were the times, if I can just interject, those were the times October would get down to $2, sometimes below $2.
Yeah, and it would really drag down, because when you're into October, you've really got the Novi March strip on the board, and it would just drag that whole curve down, or at least widen the Oct-Jan spread or the Nov March spread. Those would all, just really widen out with the premium in the March and the January. So yeah, this year we've seen the total opposite, where the front month, the Nov Dis, have rallied to the point where on Monday, November was almost 31 cents over March. And, Mike, I heard an interesting theory about this earlier this week. Mm-hmm. In my mind, if storage is the issue, I'd rather have March gas than December. In my mind, I think, look, I'll just pull out of the ground in December. And if I can right now buy March at a 20, 25, 30 cent discount, I avoid storage costs and I can, buy it, capitalize on that spread. And yet I heard a theory that the reason the front of the market was rallying more over is that people are protecting their storage and they don't want to sell out of it. They'd rather buy in the cash market.
Okay, interesting.
Right? I mean, we're not even in that window yet, but I don't know. I think that is, the wind has come out of the sails on that one. And just before we got on here, I think that December-March spread had gotten down to 18 cents.
Right. I've been following it since you brought it up, because I've been following Opportunistic Trader the last couple of days, and I have seen that Dis March go from a little over 30 down to 18 this morning. That's an interesting theory that, to be honest, I don't know. But I think this dynamic, the first signs of it are back with March earlier in the year, or end of last year, that you and I have talked about it, where traditionally you look for the March-April to blow out, and so many times it catches people, off. But getting it wrong. But this past year, that March blew out rather than the March-April.
Yeah,
and that was the kind of, for me, the first signal. And looking back, of course, that wait a second, are the dynamics of the front month over the back months? In this case, January or December and January over March, are they changing? Based on what you said, that's an interesting theory and may describe it.
Yeah.
Go ahead.
Well, no, I was, we had talked about that, and we're also, you had pointed out, you were taking a look at the LNG strip, and saw that spread, the March spread in LNG.
Yeah.
And it's not, I wouldn't say it's so much that the curve is trying to follow or shape itself around that. However, it does point to heavier demand in Jan and Feb from the LNG market than in March, just from the structure of that curve. And so that alone, would kind of lend itself to a Jan-Feb blowout premium over March.
Right.
In prior years, I'll wonder what that's, with storage at the levels it is, last year we had pretty good storage levels, although we healthily drew down. I think we drew down like 2.5 over the winter. And so it wasn't for lack of demand. We had a very cold winter. And maybe the theme is going to be this year that people value what they have right now more than they do in the future.
Right. Yes.
So yeah, it's been pretty crazy. And for me, I was short the spread and I covered it. I would love to see the December flip back under, but I'm not sure. It seems like, especially in the overnight markets, when they do their overnight buying, they're buying the front few contracts. And so it's actually made it kind of a nice day trade. You walk in the morning and the front couple contracts have been bought up so much that spread just naturally widens out. And you kind of have to wait till the market opens until, the regular players get in there and start to bring it back in line.
Yeah.
And so we'll see if that trend continues.
First of all, did you hear my dog bark? Sorry about that.
I did. What's his name?
My good luck dog, Mishla the Vishla. But what I wanted to say is that you bring up an interesting point. What we may have here is a battle between the industry that may want to protect its inventory, like you said,
right,
versus speculators and those with reasoning this as rationally, like, why would I want to be long December when I can be long the March at discount, like you said? So it might come down to who has a more driving influence in natural gas right now. The industry, if they are hedging this way, or speculators who look at the DC March and go, that is so irregular, it's worth a shot.
Right. Right. Yeah. It's always so hard on those spreads when fundamentally it's hard to support the front being over the back, right, within the winter strip. And yet, it's vulnerable to blowing out. Right. So it's hard to pick it's just like people deciding what level do you hedge March, April, or do you short March, April, right? And I just, right, I can't do that because I come from the era where I've seen it blow out to greater than $1,
Yeah. I'm sure some people are looking at butterflies also, whether it's DC Jan Feb or Jan Feb March. But I like what you have been maintaining the last couple of days, that if you're going to go long, March is the contract.
Absolutely.
Because of that discount, why choose December, even though that may spike more? That rally in December has a potential for dragging March up a little bit at least.
Well, that, and with everybody spreading and using March as their short, we could end up with a situation where, March as, a contract, gets a little crowded short. Yeah. So that so it's just something I'm keeping in the back of my mind as we get closer. I mean, I don't know that, there'd be any sense of forcing anything, now when you can buy any of the other contracts. But I think it will be interesting to see, especially if we get closer to March and things still look, pretty bullish. I saw the seasonal weather forecast came out on Monday, one of the services that puts out, their seasonal updates. Mm-hmm. And man, February looks frigid, looks Arctic.
Is that polar vortex?
Yeah, for sure. Yeah. So I don't know. And quite honestly, I remember hearing that October was supposed to start out being actually really cold. Yeah. And I mean, it was 85 degrees here yesterday. I think it's persistent heat actually these first couple of weeks. The air conditioning running nonstop.
Yeah, as you know, like in central New Jersey, this time, usually beginning of October, we begin to see leaves turn, and leaves are on trees, and it's all green here. So,
I know, you're right. All the trips up, to go look at, you know what? I didn't even think about it. I was just thinking I'm kind of sick of summer, which I know I'll regret. But I think now they're saying November. Now they've cooled down the forecast significantly for kind of November, December, and really for February. March isn't really in the window yet. So, I think what this week or the last week really showed us is that finally we can see that this market has the potential for rallies, but I don't think this is the rally. You know, we still have to slog through. I think by next week, really every place kind of ends up getting back in the 50s and whatnot. We still have to kind of slog through that. And, you know, people always get, you know, the bull run just doesn't start and then, you know, never have a pullback. And especially with how fearful people are or skeptical in any rally in natural gas. And, you know, I was going to ask you, so the calendar 19 strip, it really hasn't, it certainly
much,
about $3. It's still 280 or 290.
It's 287-ish. The highest I saw it get on the highs last week or early this week was about 296, 297, I remember. And I think Cal 20 is like down at 267-ish.
Well, and I had a theory that, you know, a lot of the oil hedgers, you know, they had a chance to get some things done earlier as kind of the whole curve shifted higher. And I feel like natural gas hedgers kind of wait until fourth quarter because they like to get that rally in the winter contracts to pull up the whole calendar strip. Mm-hmm. And since it's not moving, is there any angst or impetus? Are you seeing any people really kind of wanting to pull the trigger, but they want higher levels?
Yeah, exactly. About 3 weeks ago and the preceding 3 or 4 months, you know, the mantra among, you know, the people I do business with was just wait till we get above 320. We're coming in hedging.
For the strip? For the whole strip?
Yes, for the winter strip and spot, which, you know, the closer we got to November, spot and the winter strip they're not necessarily surrogates, but, you know, the winter strip starts with the NOV contract.
Yeah.
But I was hearing just wait. And as a broker, I'm like, yes, please, you know, I want to see action. And when we first got above 3, I saw more action, not just in orders, but in terms of requests for quotes. And this last week, it's to be honest, it's been quiet. In part, I believe, because there hasn't been a lot of movement, as you said, in the Cal 19, and not even that much in the winter strip, as far as I could see, at least from my vantage point.
Yeah. Well, so what you're saying is that they'll they might hedge the winter strip separate from, instead of doing the entire Cal. And then I can see the hesitancy, right? Do you want to give away the most expensive? Is this the time to hedge the most expensive part of the curve?
Yeah, I think a number of my, you know, clients look at this as a great pricing opportunity here as hedge sellers, as, you know, producers selling in the market. But I'm just not seeing as much interest, at least as I thought I would see at these levels.
And, you know, it's not so much that they come out and just, in general, right, sell a strip. It's more in vogue to do those fences, right, or costless collar.
Right. Or anything as close to a costless collar as possible.
Yeah.
And I put on the chat, not only to give you an idea of the skew in the winter strip, with the market at the time right about 320, actually it was 322.5. The $3 put and the 345 call. The call was a 2-cent premium over the put. So that reflects, again, a little bit more bullishness. That's also part of the options volatility.
And did you say that was Cal 19?
No, that was the winter strip.
Right. Okay.
Yeah. But I'm not seeing much in Cal 19 at this point.
Right. And because nobody wants to really force that, you know, 275, 280 balance of the year, right?
Right. Because if you're going to hedge the 287 level, for instance, you're possibly going to be looking for a put as your anchor or as your floor, maybe down at the 260 to 270 level, that put strike, and look to finance it by selling a call strike, the higher up. By the way, I just want to, as we're talking, I'm noticing the March $4 call, because I've been talking a lot about that. And just yesterday morning, the market was higher, and that March $4 call, I think, was like close to 9 cents theoretical value. Today, I'm looking at the March $4 call, and that's actually just under 10 cents. Theoretical value is 990.
Well, vol collapsed quite a bit right after the number.
Yeah, but I'm not sure why that March $4 call, to be honest, is like now.
Yeah, that lottery ticket, right?
Lottery ticket. But
yeah.
You and I have had this conversation.
But it's not really, because it's too expensive.
Yeah. So if you're bullish, besides going into the March contract that you've outlined the reasons to do that, when I look at options, I'm not sure what you buy to go long this market if you're a spec and you're looking to buy calls. Because of that skew, and beyond that skew, the psychology of buying calls has made call options very expensive. And that kind of brings out the contrarian in me and makes me want to look for puts. And exactly. I do want to say as a disclaimer, as a broker and as an associated person, that I don't make predictions,
right.
or at least that I tell people.
Right. This is not an investment advice.
Yeah.
I do that a lot. When the vol collapses, I'll pick up a bunch of puts. Yeah. Which I can buy the underlying against, and it continues to work out because it's hands down cheaper than a reach for a $4 call in March, when you'd have to rally $1.80 before. Right.
So the equivalent on the put side. So let's say the March. I'm just checking the March $4 call has a delta of 22, right? Yeah. And when you're buying puts in the scenario you just said, you usually go to the front month, right? November.
Sure.
Case, and the closest strike to a put that has a 22 delta, about the same distance out of the money, is a $3 put that I saw you'd gone long and you booked a couple of profits, and those I think you said you took in like at a penny or just under.
Yeah, I think 0.8 cents.
Yeah.
Now that's a lottery ticket I can get around. And you always kind of have to, especially when there's some moves. And it wouldn't have. There was no reason to even be interested in that play this whole summer. There was just no move. But now, as we're getting some volatility, it definitely pays to look at those cheap ones as we've had a big move, because you just need a little pull, a little angst today in the front market and yesterday, and those things went up to 3 cents.
Right. And you still, I think, have the same play with that strike or an equivalent strike, maybe the 290s, which are a little over a penny value, because we still have 15 days to go. Right. And these options work really well. They have a high delta with so little time to go, and they have the most gamma, so the most bang for your buck.
Exactly.
So with the market at 320, looking at a $3 put, that's 2.5, like offered at 270, 280. That may be a little steep, even though that's only, $250 an option. I still like the even teenier ones.
And now, it was interesting coming into before the October contract expired. There was just no hope in rallies, and so it was the $3 calls.
Exactly.
But now it's kind of switched. People are in the mindset of there's no chance we're going to come off, and so that's just good for everybody to keep on their radar. And I kind of want to stay on the option topic, but I want to bring up something that not everybody might be as familiar with. And I started to think about it the last couple days that it would be good to bring up, because
I got to hop for 1 second.
Yeah, no worries. People always talk about in the S&Ps how there are all those weekly options, and realistically, there's an option that expires Monday, Wednesday, and Friday.
I'm back.
and it just breaks, all that premium down and makes for all of this stop hunting during, within this really short-term window. And I had really not thought about for a while, but the natural gas has a pretty robust same-day option market. So every morning, they're called SDOs, and they trade every day of the week, and they're settled based on whatever the prompt futures contract settlement price is for that day. They especially can get active around inventory days, and especially just even in the winter. So whenever there's volatility, so it's always a good thing to walk in the morning, and you can kind of take a look at what strike on the SDO is being put out there. And I think we talked about it this morning, Mike, that the 315, and they're generally like half a cent at a penny or 2 cents, depending. And, people will either buy them because they think, we could have a big reaction to the number, or sell them against a monthly option that they have and just kind of try to take in some little premium every day. But I find it uncanny, just as with looking at straddles, strikes and straddle prices in the S&Ps when you walk in the morning, you always get a sense of where people are kind of thinking, the market has risk to head towards by what is the popular same-day option strike trading out there.
Yeah, the typical bid on an option that's about 5, 6, 7 cents out of the money is a half tick bid, a half cent bid, or 5 ticks,
right,
or $50 per option bid. And the offer could be anywhere between 1 cent and 2 cents. And today it was a half tick at a 1 cent offer for the 315 put when we were right about 320 or 321.
Yeah, and I would have bought that, because just for today, it was getting a little messy and moving all over the place, right? Instead of having to get in and out and try to swap the futures around, you just pay a penny to perhaps play.
Right. Or if you were, another strategy would be, not necessarily with that put strike, but if you were very bearish here, you're shorting the market, you could pick up a couple of those as either, a stop loss that could be more effective than an actual future stop loss.
Right.
That's one way to trade. It's harder for me to make a case to sell the strike for only a penny. To me, that's a teeny. And if you have an axe to grind and that fits somewhere, that's a different story. But yeah, I'd always, look at the same day option, which is the product code is KD on the CME. I always look at that as something to buy. And the only thing is, and this is why I like your idea of buying the $3 puts, for instance. Not only when you did turn out to be, the $3 calls, but I liked the idea of buying a November option, in this case with 10 or 15 days to go, much more than the same day, to be honest. And that has a lot to do with liquidity. So let's say with the market at 320, you bought the 315, the market dropped. Okay, they're financially settled, so that mitigates some of the liquidity. But during the day, if I bought the 315 put and the market's now at $3, trying to get out of it, I get much of a market. Where with the liquidity of the $3 put here, if that's a put you buy, the spread between the bid and the offer is 1 tick, or up to 2 ticks.
Yeah, you definitely have, it gets tricky if you go way in the money, unless on that particular day there's a bunch of people trading them. But I kind of just wanted people, I had sort of forgotten to mention or bring up that there is this same day, of course, every market has just broken itself down into consumable expenses, right? And so instead of having to pay the whole month in any of these futures contracts, they break it all down into days.
Right. That plus the not every market maker that I work with in options for either crude or natural will make same days. Same thing with the crude weeklies. Actually, just to jump to crude for 1 second, the weekly option for crude, the one that expires this Friday, traded close to 4,000 lots yesterday, and I don't have the levels. It settled at 10. And
what was the strike? What was the strike?
The 71 put yesterday.
Oh, sorry, I missed that.
Yes, I actually, thanks for bringing it up because I did not mention the strike. could be helpful in any analysis. But anyway, yesterday the 71 put, when we were $1 higher, it settled at 10 cents. And I didn't see the levels where the action was. I saw this after the market, looking at different trades that went on that didn't come across my desk, and I saw 10 cents. Well, this morning, the $71 put, when November crude, TI was at 72.02, just $1 out of the money. It was already 20 bid at 25 with the 22 delta. And,
dang, I wish I'd thought to look at those.
But again, I'll just repeat that option is one that expires tomorrow, and already this morning with the market already down $1, that 71 put had increased in premium from 10 cents yesterday to the market being 20.25. And one reason I wanted to mention that is just to give you an idea of the liquidity in that option, that in this case, the spread between the bid and the offer is 5 cents.
Yeah, they get really wide, because, it just evaporates so quickly.
That plus not a lot of traders, not a lot of market makers will make a market in it.
Yeah.
That changes, with more volume, more liquidity, or more, just more participation could narrow that bid-ask spread.
Yeah, and really just the message is that, in these energy products, and especially ones like natural gas that you might not think of, there are those products are actively traded across merchant desks and energy desks and funds, and certainly are a signal as to market sentiment. And I always it's just been so boring and there hasn't been much move lately that it's like you hardly even can get a penny out of anything in the first place. So why would you want? But now I think it's a good time to put that back on the radar and start using that for some information.
I like that. Even if you choose an option with 10, 15 days to go versus the same day, it's good to look at that because you never know how you could fit that in. And they are inexpensive if you're a buyer, risking a penny for them. By the way, in preparation for discussing the markets with you today, I looked at some other 1 days. I actually looked at 1 day options of electricity just to see if there was any open interest. Well, there wouldn't be open interest in it because it expires today, but I wanted to see if there was any volume.
Yeah.
Any of the same day electricity options. I didn't see any. I know there are probably some electricity contracts out there I didn't see. Well, but I figured that would be interesting.
Electricity has so much of the liquidity has, brought itself into the very, very front of the market. And in electricity, there's a contract that trades called balance of the day.
Okay.
And it literally is the 16-hour peak time period, which on the East Coast is hours ending 7 to hour ending 23, 22, right?
Is it any particular electricity or all electricities?
So the major hubs that will trade would be like PJM West Hub, MISO, Midwest ISO, ERCOT has a balance of the day market, but if we're just going to talk PJM, it's essentially you get in, and it starts pricing out throughout the day against the ISO's posting of real-time prices. And so there are literally people sitting there all day long. They know what the first two, maybe it's or 9 a.m. So 2 hours have already priced. So there's like this known component.
Got it.
Financially settled fix for float swap, essentially, right?
Right.
And then trying to predict what the last 14 hours and it keeps going down, right? 13 hours, 12 hours. And it's so funny over the years, the products that have the software that's been developed that really is geared towards trying to feed in all of the load and supply and demand data and, spit out predictions and in almost an algorithmic way, right? And there just has gotten to be, since electricity is in such a flux of half regulated, half not, so many people, that's when they're trading electricity, they're literally swatting around that front contract and there's a lot of volume. And so of course there would be also next day options. But in a way that balance of the day is like an option.
Right. It's the instrument is available there. I was also thinking while you're talking with electricity being the flow of electrons, I don't know how you would actually model an option, either.
I certainly
value for
there's two kinds that trade really. One is the monthly option, so it expires like regular futures contracts, right? The other one is daily options, so you buy like the November call, but you are able to exercise it daily. The average price option, I guess is what that's called, right? And those are the ones that get really difficult to model. I mean, in any commodity, but electricity specifically, because the daily price volatility is bigger than in any other commodity. You can be negative prices. You can all of a sudden jump to the cap price in any given pool, which is 5,000 or 9,000, depending on the different pools. And so those, people start throwing around jump diffusion models and all sorts of things, but that's really the meat of what you want. And since they get so expensive, again, people get back to just trading these balance of the days. You can almost walk in the morning, and if you think, you have some sort of opinion, you can, hopefully grab, the balance of the day for $30 and it runs to 100, let's say. Although, that's less and less also because people are forecasting, there's so much modeling being done, but hence that it's a volatile product with a lot of volume. So interesting that you brought that up. I'd forgotten about how much that trades.
Yeah.
So I'm so glad to have you here, and I don't want to take up too much time. I thought
I'm enjoying discussing the markets with you. Thanks.
Yeah, and I
thanks
think
for including me.
Certainly, I welcome anybody's feedback. I thought sometimes it can get a little dry, just doing a presentation with just a bunch of facts and a bunch of different data. It helps me to be able to have someone to talk it through with and maybe ferret out some of the ideas a little more fully with the dialogue. So hopefully this will be something that we can make a weekly or when the market requests. So I just want to welcome Mike and thank you so much. I'm really excited to have you join me on this because it's so much more fun to talk about the markets with someone.
I enjoy speaking about the markets with you, Brynne. And I want to thank you. Also want to thank Michael. Thanks for an opportunity to participate in your program and to contribute.
Awesome.
And to learn a lot. I've been just, I enjoy your long presentations. I always find the time to watch them.
Oh, thank you.
Yeah, thanks. I've learned a lot, especially about pipeline basis.
Yeah, that'll be for another day. All right, excellent. Have a great trading day, everybody. And again,